I want to talk to you about how to construct an options portfolio. If you're a brand new options trader, it can be confusing trying to create an options portfolio. Which underlyings should you trade? Which strategy should you trade on each individual underlying? It can be rather overwhelming if you're new, but today I want to give you some of the basics of how to create a basic options portfolio. So before jumping into the presentation here of building your options portfolio, when I talk about a portfolio, if you're brand new to trading, what I'm talking about is, your overall positions, everything you have on. Right now, I've got, a million different positions on and a million different underlyings, right? These are all my option positions. I've got a variety of things going on, some bullish trades, some bearish trades, some neutral trades, some undefined risk, some defined risk, and you can see I've got a lot of different underlyings that I'm trading options on. So why do I have all of those various options positions on? How do I arrive at some of my decision making on entering some of those trades? Well, first of all, if you're creating an options portfolio, you need to know what your goals are. And by goals, I don't mean the obvious, hey, my goal of trading, of course, is to make money. I'm not talking about that as a goal. I'm talking about what are your portfolio goals. Basically, I'm talking about, do you want to primarily be a bullish trader or a bearish trader or a neutral trader? You should have some basic metrics that you use to judge whether your account meets your specific goals. Now, the most important metric that you want to keep track of is your buying power usage. So as a general rule, you should stay under 50% of buying power usage. You don't want to use more than 50% of your buying power. You certainly don't want to use, more than 70 or 80% of your buying power. If you're using a lot of your buying power, you are exposing yourself to great risk, because if the market happened to crash or if volatility spiked in a big way and you're using that much buying power, then you could actually blow up your entire account. You could lose everything, and you never want to be in that position. So as a general rule, use about 50% of your buying power and then keep half of your buying power available in cash. That way you have some cash on the side to use should you need it in an emergency situation. For those of you that are using TASTYTRADE as your trading platform, it does keep track of your buying power at the top of the trading platform. If you look at the header inside the TASTYTRADE platform, it will tell you how much your total buying power is, how much buying power you're currently using as a percentage. So just take a look at that number a couple of times a day and just make sure that number, again, as a general rule, should be 50% or less. Some other important metrics to take into consideration include how much buying power you're using per position. So as a general rule, we're going to divide our options trades up into two types of trades. They are undefined risk trades, so your naked options, your naked puts, your naked calls, your naked strangles, any kind of strategy that has a naked put or a naked call as part of the strategy. Those are undefined risk trades. We treat them separately than defined risk trades, which are your spreads. And as a general rule for undefined risk positions, you want to use 2 to 5% of your total net lick per trade. That's a me rule. That's kind of the area I hang out with. I know some traders will tell you to use a little more of your buying power per trade on undefined risk trades. I think the TASTYTRADE gang, they recommend like 3 to 7%. I find that 7% number to be a little high for my liking. So for me, I try to use 2 to 5% of my total net lick per trade on undefined risk positions. Now on defined risk positions, I go quite a bit smaller. I do 1 to 2% on defined risk trades. So those are spreads and iron condors. And the reason I do a lot less on the defined risk than the undefined risk is because defined risk trades, you're actually much more likely to suffer a max loss on those trades. So as a general rule, make them a little smaller. Now there's some other things to keep track of, but I wanted to start with buying power usage and how much buying power you're using per trade to start off with, because this is the most important thing to focus on is risk management. And the greatest risk to you as a trader is actually trading too big. That's how most traders end up blowing up their account and losing everything and then swearing off trading. I'll never trade again. What was the culprit? Well, almost always it was they were trading too big. If you stay small, you're much less likely to suffer a major drawdown in your trading account. Thus, you'll stay in the game. You'll eventually figure out this whole trading thing. It's not as hard as a lot of people make it out to be, and you'll be in it for the long term, and you'll start making some real money. A couple of other important metrics you need to know are your deltas and your theta. So with delta is your directional risk on your option positions. If you don't know what delta is, I've done a very detailed video in the past about what is delta. Go watch that video. If you don't know what theta is, I've also done a very detailed video about what theta is. Go watch that video. But delta is your directional risk on your trade. It basically tells you whether you're bullish, bearish, or neutral on that position. It basically tells you your directional assumption on that position. So it tells you if you're bullish on the position, and the number will tell you if you're very bullish on the position or just a little bullish, or maybe you're neutral, maybe you're a little bearish, maybe you're way bearish, right? That's what the delta number tells you. But the big thing you need to know is you need to know the delta of your overall options portfolio. So you need to know all your positions added up. What is your overall beta weighted delta? That's what we need to know. So a beta weighted delta basically takes your portfolio and it compares your overall options portfolio to SPY. The way this works is if your overall portfolio has 100 beta weighted deltas, for example, then that means your options portfolio has the same risk as you being long 100 shares of SPY. If your options portfolio has an overall beta weighted delta of -50, that means your options portfolio has the same risk as if you are short 50 shares of SPY. So what should your overall beta weighted deltas be? What should that number be? Well, there's no good answer to this because it depends on what kind of trader you are. If you trade the way the TASTYTRADE guys trade, they want to have around a 0 beta weighted delta, right? They want to be directionally neutral overall in their portfolio. Me, I'm primarily, actually, I'm a bullish trader. I'm always going to have positive beta weighted deltas. I might have, a couple hundred long beta weighted deltas in my portfolio, and that's comfortable for me, and it'll depend on your account size as well. For example, if you had an account size of $100,000 and you looked up and you saw that you had 500 beta weighted deltas in your overall portfolio, that means your options portfolio is the same as if you were long 500 shares of SPY. That is a gigantic position, right? Because you're controlling 500 shares of SPY, which is an ETF that's currently trading around $600 a share. That's like a $300,000 stock position or something. It's a very large position, right? But you only have a $100,000 account. So you need to reduce those beta weighted deltas. You're way, way, way too long the market, So that's how you play with beta weighted delta. That's how you use the number. It tells you whether you're taking too much directional risk or not. And if you're taking too much, for example, long directional risk, get that number to come down. And how you get that number to come down is stop putting on bullish trades for a while. Put on some neutral trades. Put on some bearish trades. Another metric to watch is theta, which tells you how much money you make as each and every day passes. So again, in the TASTYTRADE platform, go to the header. It will give you your overall beta weighted delta number, and it will also give you your overall theta number. That theta number tells you how much money you make each and every day as time passes. That is what theta is. If you primarily sell options rather than buy options, you'll have a positive theta number. If you primarily buy options rather than sell options, you're going to have a negative theta number because you're punished by the passage of time if you're long options. But for those of us that primarily sell options, we're going to have a positive theta number. The higher your overall theta, obviously, the better. But be careful. If your theta numbers are very high, it likely means that you have a lot of risk on. So be careful. If that number really creeps up, really high on you, you've probably taken a little bit too much risk on. Now let's talk a little bit about diversification. So when you're constructing a portfolio, make sure that you're trading multiple strategies. You don't have to have a million different strategies on, but make sure you're mixing things up a little bit, right? If I go back to my portfolio here and I expand everything, I have a few different things going on, but I don't have a million different strategies. I have some spreads, I have some naked puts, and I have several strangles on. I have a ratio spread on, I have an iron condor on. And that's about it for strategies that I currently have on. I've got about 5, maybe 6 different strategies that I'm currently using at the moment and various things. So it's not like you have to trade a million different option strategies because they're literally hundreds of option strategies out there for you. That doesn't mean you have to know each and every one. That doesn't mean that you have to trade each and every one all the time and gain experience on how they work, but you need to have at least a few tools in the tool bag. And the reason you need to have a few different strategies is just to prevent yourself from getting too directional on one side of the market or the other. For example, most people just get way too long the market and they eventually blow up their account. For example, as an options trader, it would be very easy for me to go and just start selling puts on everything. I just sell naked puts on anything and everything. But that's dangerous, because what happens if the market crashes? Well, if the market crashes and all I have is a bunch of naked puts on things, I'm going to blow up my account. So ideally, you want a mixture of bullish, bearish, and neutral positions. You don't want to have all positions be the same directional assumption. Have a mixture of things. Ideally, you also want to have a mix of defined risk trades, so credit spreads, iron condors, things like that, and undefined risk trades. So those would be your short puts or your short strangles. Also, ideally, you want a mix of trades expiring at different times. You don't want all your options trades to expire in the exact same cycle, because again, what happens if the market crashes and you're very late in that option cycle and all your positions expire in that same option cycle? You're in for a bad time. And lastly, ideally, you would also like a mix of different market sectors. You don't want to trade, for example, primarily tech stocks and nothing else. You don't want to trade only oil-related companies and nothing else, right? You want to mix and match things. That way, if one sector of the market has a really bad time, you're not trading just that sector. So now that we've got that out of the way, let's create an example options portfolio. So let's imagine you're starting with a reasonably sized account, say a 25K account. Actually, with these positions, you could probably get away with 10 to 15K as a starter position for what I've got on the screen here. But this is a very basic first 5 trades to put on. And you can see I've got a mixture of different underlyings here. I've also got a mixture of different strategies here. Now, if you've been watching this channel for a while, you'll notice that some of these strategies are strategies that I put on all the time. I've made videos about these things. For those of you that are a member of the DT Options Discord, you see me trade some of these trades all the time. I have traded some of these trades hundreds of times, possibly thousands of times over the years. For example, a standard trade of mine, a go-to trade of mine I'm constantly doing is I sell 10 delta short puts in MES. So that's the micro S&P 500 futures products. I do a 10 delta short put, 90 DTE. And I typically, sell, a few of these every couple of weeks, every month. As they come off, I'll put new ones on. And of course, depending on the size of your account, you have to be careful. This is a futures product, so it's very highly leveraged. But in a 25K account, let's just assume you're selling one contract, one 10 delta short put. And let's imagine you do it every month. I think you could safely do that in a 25K account. I think that's well under, our risk tolerance here. A 10 delta short put that far out in time at 90 DTE and a futures product like MES typically is only going to have a buying power reduction of a few $100s. So again, when we're talking about our risk per position, this fits our criteria. Another regular trade I make all the time, and I've made videos about this particular strategy, is I sell put credit spreads in SPY. So every week, every 2 weeks, whatever it happens to be, I will put on new put credit spreads in SPY, and I typically use the 35 delta for the short put of my put credit spread. And of course, you can make it as wide as you want. Typically, I'll do mine $5 to $10 wide, but depending on how small of an account you have, you could make it smaller than that. And I'm putting that on typically at 60 DTE. These are my rules for selling put credit spreads in SPY. I use the 35 delta short option and I sell them at 60 DTE. Now, SPY is the S&P 500 ETF. MES is the S&P 500 micro futures product. They're essentially the same product. They track the same S&P 500 index. And I put on 2 bullish trades. And the reason I put on 2 bullish trades in these S&P 500 products is because I know these bullish trades have positive expectancy. They win, right? Over time, they will make money. That's why I do them over and over again. But I have 2 bullish trades in these products, right? I need to vary things a little bit, right? I need to quit putting on more bullish trades at this point. Well, let's go ahead and go to IBIT, which is the Bitcoin ETF. It tracks spot Bitcoin price. And in this one, instead of getting bullish, I'm going to do a neutral strategy. So I'm going to sell a 15 delta short strangle. So selling a 15 delta put on one side and selling a 15 delta call on the other to make a strangle. And I'm doing that at 60 DTE. This is a neutral trade, so I'm not adding any more long deltas to my already long portfolio, right? So that's why I'm doing the strangle here. It's not necessarily because I think IBIT isn't going anywhere. A lot of times when you put on positions, you're thinking about your deltas. Do you need more long deltas? Do you need more short deltas? Or are your deltas exactly where you want them and you just want them to stay the same? And that's why I'm doing the strangle, is I've got enough long deltas, but I don't need to add any more, so I'll do the strangle. The next position, I'm going to add a 20 delta iron condor at 60 DTE, and I'm going to do that in SMH, which is the semiconductor ETF. Now, semiconductors are very highly correlated to the S&P 500 because they're tech, and tech tends to drive the S&P 500 anyway. So I would not want to do a bullish position in SMH if I'm already bullish in SPY and MES. So once again, I need to do something that's not a bullish position. So in this case, I decided to do a neutral position. And in this case, I didn't want to do a neutral position that was a short strangle, which is undefined risk. I wanted to do a neutral position that was an iron condor, which is defined risk. Again, we want to vary. Defined risk, undefined risk, bullish, bearish, neutral. Again, that's how we're creating this diversified portfolio. And then finally, I'm going to sell a call credit spread, which is a bearish strategy. I'm going to sell a call credit spread at 60 DTE on GLD, which is the gold ETF. This mirrors gold futures. So there you have it. As a basic starter options portfolio, we have 5 positions. One bullish position that is a undefined risk trade. We have one bullish position, which is a defined risk trade. We have one neutral position that is an undefined risk trade. We have one neutral position, which is a defined risk trade. And finally, a bearish position, which is a defined risk trade. Again, a nice mixture of things. And not only a nice mixture of strategies, but we also had a nice mixture of underlyings. And you will notice those underlyings, we didn't have any individual companies. These were all futures and ETFs. Nothing has single stock risk here, right? Now, if you wanted to mix in some single stocks, like an Apple or Nvidia or Microsoft, you certainly could. But again, for purposes of this video, I was kind of doing things safe. And these ETFs are obviously much safer than trading a individual company's stock because those things have much more volatility and you can get hurt on those things if you're not used to how they move. Now, one thing to note is our example portfolio there, that wasn't using very much buying power. None of those trades took very much buying power. 4 of the 5, I don't think used more than just a few $100 worth of buying power. So yeah, the gold trade, the SMH trade, SPY and MES, none of these trades took more than probably $500-600 worth of buying power. The IBIT trade, because it's a naked short strangle, takes a little bit more buying power, but right now, last I checked, a strangle in IBIT takes around $1,200 worth of buying power. That's still a perfectly okay trade. Remember, we're not trying to use more than 2 to 5% per trade on undefined risk trades based on our portfolio size. So $1,200 versus our $25K account is perfectly reasonable. And in total, all 5 of those trades, we're still nowhere close to using 50% buying power. We're way under 50% buying power. In fact, we actually need to put on more trades than that. But those 5 trades, they're just an example. They're what I would consider a nice starter set of example options trades. Basically, they're a nice group of trades to just go put on right now and then gradually start adding more positions because you're going to need to probably put on 2 to 3 times as many trades as what I did as far as, if you were having a 25K account, you need to put on more trades than just those 5. But as you do, keep diversification in mind, right? Keep an eye on your metrics like your delta and your theta and your buying power usage. Now, one other thing to note is that in my example trade, you'll notice that my DTEs were not well diversified, even though I said you should diversify your expirations. If I go back, you'll see Yeah, a lot of 60s and the 190, right? So not a lot of variation in the DTEs. And this is because we're just starting this. And these are typically my starting DTEs for a trade. But naturally, these will get diversified as you start trading because eventually some of those positions will come off as winners. Some of them will win very quickly and come off. You'll put on a new trade, maybe in a different expiration, a different monthly expiration or weekly expiration. So even though they're not very diversified by expiration when you start, as you start trading, they will naturally become more diversified. And if I go back to my trading platform here, you can see that I am pretty well diversified by DTE because obviously these are not trades I just put on today. Some of these trades have been on a little longer than others. You know, old trades come off, new trades come on. So you get a mixture of things that are expiring anywhere from 11 days, 42 days, 59 days, 32 days, several 59s and 32s, lots of 42s, you know, even got some one-day trades in there as well. I've got some long VIX call hedges that look like they expire today. I've got some different stuff on, right? So that is how you diversify, and that's how you start thinking about constructing a proper options portfolio. Again, you want to be as diversified as you can, have different underlyings, have different directional assumptions, have different strategies, defined risk, undefined risk. You just need a little bit of a mixture of everything, and that diversification will help protect you. Now, if you want to see somebody maintain an options portfolio and put on new trades and take off old trades, if you actually want to see an options trader in action, subscribe to the DT Options Discord. I actually share my trading platform there each and every trading day. Every day that the stock market is open, I actually hold a live voice chat in the mornings there, and I share my trading platform. You guys get to see new trades I put on, you get to see the winning trades that I take off, and you get to see how I think about constructing this stuff. And the more you see an experienced trader like me, my thought process behind some of the things I do, the more you'll realize how this stuff, even though at first it seems rather complicated and maybe a little overwhelming, it's really not complicated at all in the end. Peace, guys.